Good morning. Welcome. I have my Tradier Swag shirt on today. One of these days, we'll get some Option Pit t-shirts and hats and stuff. I think we should let Leisha on that because she's our design expert. You know, Leisha also was an interior design major or something like that. That's why she likes to chart. She's very spatially oriented, I think. Anyway, that's aside. So today we're going to talk more on our Tesla and Google because we have earnings tonight. I believe Mark is going to go live tonight. Also, if you want to see how these stocks fit into the AI narrative, check out Hans. Check out the link above. And how he uses MTI to do it. Yes, maybe big blonde hair could help us design some OP swag. That's Mark's wife, Lauren. Yep. Anyway, so there's another concept I wanted to give you here today. Scott says U.S. existing June home sales falls 3.93%. Oh, you guys got a lot of questions. I'll tell you what, I will answer all your individual stock questions at the end of class. How about that? I know you want, I want all this information now, but it's not just about you. It's about everybody else that's here. By the way, that's why we had pay services. All right. So we're going to talk about Tesla and Google today. We're also going to talk about a concept called skew. If you've ever heard about skew, write a note into the comments here. Like, I know what skew is, Andrew. You don't have to tell me. How many people were here yesterday and learned something new about all that weird option stuff, how time works, how liquidity providers do things? All right. All kinds of stuff like that. And then I think we'll take a little look at maybe a couple of big tech stocks for next week. Now, we did cover a little pricing here on Google. As I recall, we were looking at the July 25. The call and put was trading for almost $11. By the way, feeling skewered or skewed after coming home late, Jose, is different from the skew that we will be talking about. However, so let's see how Google's doing here. And by the way, why wouldn't existing home sales start declining when interest rates are high? Buying a house is expensive. Those prices have to come down. They got crazy. So here, I want you guys to see this. And let me see here. Has time stood still here with Google? Has time stood still? What's the value of that strangle now? It's $11.35. What was it yesterday? I have it at $10.95. So what's going on here? How is this thing going up? Did you guys see how the price of that thing jumped from yesterday to today? Now, if you're trading and the price of a strangle all of a sudden goes up. Michael Movie is saying earnings. Yup. Again, it's my belief personally, I think Google is going to make a little bit bigger of a jump on earnings than people expect. What is the vol change? Asked Sniper. Well, today it's 94.18 Sniper Baker. And yesterday it was 76. So the volatility is up 18 points. And the option prices are up roughly 30 cents. So what I want you to get a sense of is what's really happening in money terms. Right? So the volatility on the strike is up roughly 18 to 20 points, almost 20 points. The option prices have expanded to only 35 cents. So the market is doing what? It's constantly adjusting. Now, and also if you think about it like this, if option prices are rising, what do you think the public is doing? What I call paper, right? So when we get into the skew conversation, if option prices are rising, what is paper? And paper is you, me, and everybody that's not a liquidity provider. There's a liquidity provider universe, and you ain't in it. I used to be in it in the good old days, but now I'm just here teaching you all the dirty tricks I learned as a market maker. So there's a liquidity provider community and how they respond to all the paper that comes in. Everybody in the world is paper, and they set prices. So if option prices are rising, what is happening, right? Okay, is if option prices are rising, what is happening? That means liquidity providers are selling. Is that what you meant, Senior Roberto? Right? That's what that means. Oops, I don't like any of that. Oops. So all of a sudden, again, and I don't know if the stock's going up or down. I personally believe I think Google's probably going to do a little better with AI than people think, right? I think it's overall going to help them, but we'll see. Liquidity providers are net selling options. Now, another question of the Sniper said, don't you need to add the expected theta decline to the vol increase to get the real impact of the vol increase? So basically, when you see implied volatility, right? I think you're doing an extra step, Sniper. All you're looking at is how much the vol, where is the implied volatility for the option prices currently? Right? So all implied volatility is it takes the price of the options and generates the IV using the model in I want to think of what's like a reiterative basis, right? They're basically backing the implied volatility out of the option price. So the real impact of the vol increase, none of it really matters, Sniper, because right now the theta is 0. So there's always a theoretical theta, but you're never guaranteed to get it. Okay, how many people in here have sold options, but then they don't decay? And you're like, what the heck? What kind of crap is that? Right? That's just volatility going up, reinflating the option price. So in the short term, options just aren't decaying. But like I said yesterday, what changes every single day, no matter what? Right? The sun she rises, the sun she sets. And right, the date always moves closer to expiration. Your options might not decay how you expect. So right now, the market is pumping this straddle up just a little bit more. Now, here's something that I found kind of interesting. And this is the idea of skew. Skew is basically, so the liquidity providers have lots of ways to cheat. Okay. Now, I know because I used to be one. So, but they don't cheat in the way you think. What they do is they cheat the option model. Right? Because the option model always wants, what is the option, the imply like, so when do you ever wonder where these option prices come from? Right? Do you ever wonder where option prices come from? They come from a model. And every firm that provides quotes to the exchange, right? The exchange doesn't make any quotes. All they are is a conduit for quotes. Every firm has their own model. So options, liquidity providers, they cheat the option model by adjusting volatility. Okay. The normal volatility assumption is one volatility per strike. So if I show you this and you're like, oh, that volatility is 95.20, that's 95.82, that's 96.18, right? So there is a little bulge in volatility to about, I'm going to say 197.200, right? So again, if I'm looking at this, if I want a cheap call spread, you buy the option that's cheapest and you sell the option that's more expensive, and all of a sudden you got a, you got a 7-point, 10-point call spread for $3, $3.50. The fact that they are charging more for these options, this is where the action is. Traders are thinking, in my view, that Google is going to move above 200 based on the volatility from the money to 200 is rising. Every single strike is rising a little bit, and it's peaking around right there. Jose is saying you get a nice spread in your favor. Right. The spread in your favor means it's cheaper. The only reason we bring any of this up, skew, implied volatility, realized, all these concepts, it's to make your trades cheaper for the same result. So if I think a stock's going up, I want the cheapest way to do it. It's going to make me the most money. Okay. Where is the market giving me the best deal, right? If you're buying a car, okay, and one lot has your car for $10,000 and the other lot has the same car for $9,000, what car are you going to buy? Do you want to buy the $9,000 car, or the $10,000 car, the $9,000 car? It's the same with options. If you think the stock's going to 200, you just want the most efficient deal. The 200 call might not be it, because if you stop at 200, what are you going to get? But if you buy the 9,200, you could get a double or a triple. And the market is giving you that because they're charging more money. The implied vol, I want you to see here, the volatilities are rising and peaking at right around somewhere between 97 and 200. So that is where, like I would say, the bulge in the activity is around those numbers. Market likes it. Okay. Now, on the flip side, Do you guys see how the volatilities of all the puts, 95, 94, 93, 92, 90, 89 are going down? Do you guys see that? Put volatility is going down. Traders are like, okay, I'll take Tesla, I'll take Google at 180. I'll sell this put for $1.55 and take the shares at 180. So I would say, at least for this stock, this skew is fairly bullish. So, right, the skew is just how the, right, any skew clues, right? We'll go to skew clues. Okay. How the LPs, liquidity providers, that's not you, used to be me, but not you right now, how the liquidity providers are changing option prices based on flow, order flow. Is falling put skew normal? WA, I would say no. We'll look at Tesla in a minute. Again, in my view, I think Google is one of those stocks that people were uncertain about in the whole AI scheme. Remember, if you want more on that, check out Hans above. Okay, check the link above. And I think it's, but it's probably been underperforming in that realm since then. And maybe this is the earnings that turn it around. Certainly, that's where the money is pointing. Can people see that higher volatility at 200, right, than at, where's Google right now? 191 something. So it's 190-ish, right? So they're paying more money for the 200 call than they are for the 180 put. Do you guys see the difference in prices there? We are $10 away, roughly $10 away, and the 200 call is way more expensive than the 180 put. Do you guys see that? 160 versus 220 for $10 away. Now, there is normally a little higher skew in calls in the model normally, but also you got volatilities 5 points higher. So the skew trick here, the skew clues, right? There's flow going into those strikes. So I would look at, right, so here there's definitely some positive skew going into earnings. Skew clues. Do you see the picture that I'm trying to draw for you based on how the market is pricing the options? This is just a screen that anybody can do. WA is saying, do you always do this skew analysis before earnings? And the honest answer is, WA, if I have time to pay attention to it. If I have time to pay attention to it, depending. I normally don't do any earnings trades unless the option pricing looks very favorable. So it's mostly things I will fall into if I'm looking at the stock. So this week we had Google and Tesla. I thought I'd take a look at it. I'm like, oh, I hire my son to do this. I might next summer. He's expressing an interest. All right, let's look at Tesla. So I would say our skew clue, our blues skew clue, our skew clues is we have, right? I would say this is for a trending upward. And I did, in fact, do a trade for a rip zone for this we talked about it in our Rip Zone class yesterday. So I did put something on there. But join Rip Zone, then you can see what it is. All right. Now, for Tesla, let's see what we got. All right, Tesla's up a little bit today. And let's see, first off, if there's more. Tesla's one of those ones that is always a weird one on earnings. I'm just going to look at the our earnings analysis here. All right. Now, the market move here is around 12% average. The average implied move for the options is only 8%. So Tesla has a tendency to kind of blow things out one way or the other. Now, I think this move was an outlier because the stock was actually a 20% move. But also, I think, this was around the election. Tesla was really in the ash can and stuff like that. So, I think it was a one-off. But I think this was an outlier. It's probably more like 10%. But mostly here, you have negative. You've had negative move, positive move. So it definitely moves. Right now, the options are only giving you a 6.5% implied move. Now, again, when I look at this, right now, the story with Tesla is, the Trump, Elon Musk love-hate relationship that's been going on. Is the conclusion to draw from the skew analysis is that the market makers expect Google earnings to be better than expected? Not the market maker, Sniper, paper. Paper pushes the prices, the market makers adjust. Market makers generally don't have any opinions. They just move the pricing, right? They cheat. They move the pricing based on demand. So if you want to keep buying it, they're going to keep charging you more for it. Does everybody get that? If everybody came in and wanted to buy the same option, they're just going to keep raising the price. They will not stand in the way. They will continually raise the price relative to where the stock is. That's how implied volatility goes up. Jose saying, so they are neutral skew. I would say on balance, that is an objective, yes. On balance, market makers, you could have a position as a market maker. You might have 25,000 contracts in Google open, but net, it will be relatively flat skew until you can unwind them. Unwind meaning close your positions. So again, we can all have opinions, but what are the options trying to tell us? So is the straddle more expensive or less expensive than it was yesterday? Let's see if there's anything we can glean from this here in the last couple minutes. So Tesla. So I had our straddle at $24 and let's say $24.35. $24.35. And right now, 24.25. So the straddle here is down about a nickel from yesterday, although it's going to show a higher implied volatility. So not a lot of change here. Also, do you guys see the skew difference here from 335 to 350? Do you guys see how the skew is negative from 115 to 112? Does everybody see this? The 115 to 112 is exactly the opposite of what Google was. Paper is not coming for those upside calls. The skew clue is they are not coming for the upside call. Let's see the puts. 114 down to 113. They're not even coming for the downside puts. Do you guys see how most of the volatility is near the money, and from that, all the volatility is decreasing? right? Most of the volatility is near the money, and the volatility on the tails is decreasing. This is a different pattern from Google. In my view, market makers think we move from the money somewhat, up or down, ambivalent, but the move is not going to be that big. Probably around 7-8%. So the skew clue here is a little different. Tesla skew cube, right? Okay. So what this normally means to me is there's not demand for the big move outside. Okay. We need a skew clue service. We could do that one day, William. But ultimately, it's a very advanced class. I do it every once in a while in pro. If something looks interesting to me, I could get 1,000 services on how to just price things. But we have Hans for Turbo Income above. Take a look. If you want to look on how to take these stocks and create trades around them. So I would say our skew clue for Tesla is, again, if I was structuring this, I would actually buy the junk on the tails and sell the stuff in the middle, which would be a slightly different trade. Cap is saying, so I would be inclined to sell an iron condor on Tesla. That's what I would do, but I would add a couple extra option contracts, Cap. He's saying, so I'd be inclined to sell an iron condor on Tesla. Something along those lines. Again, not a trade recommendation here, because I think for the average person, iron condor and earnings could be a little, you sell something thinking you got, a for sure win, and then it blows through a strike. Normally how I do these is I sell at the money, but I buy extra tails. Since the paper is mostly institutional, maybe Sniper Baker, is it saying that the institution expect nothing out of the ordinary from Tesla earnings? That is how that's how I would look at it. Did the screen freeze? Ooh, I might have froze. I don't know. Let me see here. I'm back. So that's what we have. I think kind of underwhelming Tesla earnings, slightly bullish paper and Google. But guess what we get to do this week? We get to see if it's right. All righty. 0 DTE. You guys, check out Hans. Check the link above. Check us out at 4 o'clock today. And it's 0 DTE time. I am done. If you want to learn more, free class every day, 10 o'clock. Learn some options right here, optionpit.com. Take care. I'm out.